Are you interested in stocks that have a wide moat and grow their free cash flow by 12% per year? If so, you're not going to want to miss this video on Texas Instruments. Hey guys, Kevin Burgess back again with another video. This time I want to talk about a stock that I have in my portfolio that grows its free cash flow by 12% per year over a 17-year period. Not only that, but it's considered to have a wide moat by Morningstar. So we're going to take a deep dive into Texas Instruments today. In addition to that, we're going to talk about the impact on my portfolio from last week's market moves. This would have been through June the 24th. You know, I'm so glad that you find value in these videos. I'm excited and humbled to tell you that we have over 600 subscribers now. So if you're watching these videos and you're not a subscriber, if this is the kind of content that you're looking for, if you like to talk about dividend stocks, then consider subscribing to the channel. I'd love to have you along for the journey. So with that, let's get started. Texas Instruments was founded in 1930. It's headquartered in Dallas, Texas. But what they do is design, manufacture, and sell semiconductors to electronics designers and manufacturers worldwide. It operates in two segments, so analog and embedded processing. The analog segment offers power products to manage power requirements in various levels using battery management solutions, DC switching regulators, AC/DC and isolated controllers and converters, power switches, linear regulators, etc., etc. The second segment is the embedded processing segment, and it offers microcontrollers that are used in electronic equipment, digital signal processors for mathematical computations, and applications processors for specific computing activity. This segment also offers products for use in various markets, such as the industrial, automotive, personal electronics, and communications markets. So let's take a look at their revenue. $14 billion of their $18 billion in revenue came from the analog segment, while $3 billion of the $18 billion came from the embedded. Then you'll also notice that the key markets, the 41% of their revenues is in the industrial market, and that's going to be important later. Then they've got 24% in personal electronics, 6% in communications, and 6% in enterprise systems. Also, let's take it some pretty incredible stats. These are on their website. Their free cash flow per share has grown by 12% annually from 2004 through 2021. So as you can see on this chart here, their free cash flow per share has grown over the last 17 years. And it's important to notice that it doesn't necessarily grow in a straight line, because there's going to be times where they are investing in buildings and increasing their tooling and their research and development. So there are times that the free cash flow spikes, and there's times that it goes down, mainly related to capital expenditures. But a 12% annualized growth in free cash flow is a tremendous record to have. They have 18 consecutive years of dividend growth at a 25% CAGR over that 17-year period. And they have reduced their share count over that same 17-year period by 46%. Let's talk about their market for a minute. We discussed a little bit earlier that of their $18 billion in revenues, 77% comes from the analog business. And you can see that this analog market is pretty fragmented. Texas Instruments is the #1 player in this space, but they only have about 19% of the market share. I think it's also interesting to see the pace at which this market grew from 2020 to 2021, which was at a 30% pace. Now, what we don't know is what COVID impact was in 2020, but regardless, 30% is a pretty big move in any market. The top 10 players in this market only have like 68.2% of the market. So the other 31.8% comes from other players as well. So why does that matter? It matters because there's a potential for acquisitions and consolidation in this market. So let's move back to Simply Safe Dividends. We'll notice that Texas Instruments has a 90 rating out of 99. And we'll notice here that while they grew their dividend by 13% in September of last year, they have a 5-year dividend CAGR of 21%. And when you look at this dividend growth chart, I mean, it is exactly what you want as a dividend growth investor. And when you want to talk about consistency, look at the last 20 years. Their last 20-year dividend CAGR is 22% growth. That's a very fast growth rate and very consistent over a 20-year period. You'll notice here that they have paid a dividend uninterrupted for the last 33 years, and of the last 18, they have grown it consistently. Their dividend yield is 2.96%, which is above their 5-year average, and their PE ratio is 17.9, which is well below their 5-year average. So according to this analysis, they may be undervalued. They have an earnings payout ratio somewhere in the 50% range, depending on what year it is. A couple of years was in the 61%, 60%, but mainly 50% or below, with a free cash flow payout ratio around the lately in the low 60s, but historically much lower than that. When we look at earnings per share, we see a tremendous growth in earnings per share up through 2021. It does look like things will kind of level out here over the next 12 months. But when we think about inflation and supply chain challenges and things along those lines, this is not very surprising. So moving on to shares outstanding, we see that since 2012, they have reduced their shares outstanding by well over 200 million shares. So there's been a pretty consistent buyback program. And look at this return on invested capital, well above 35% over the last 5 years or so. So they are definitely utilizing their capital in a very efficient way. A couple of other things I'll point out is the net debt to capital is 0. And what that means is that they have cash that is greater than their debt. And the way that we can see that is if we go to financial statements and go to the balance sheet, you'll notice that the cash balance, we'll take the December 2021 balance, is $9.7 billion in cash. And we'll go all the way to the bottom so that we can get the total debt. The total debt is $8.2 billion. So they have $9.7 billion in cash, $8.2 billion in debt. If they wanted to tomorrow, they could pay off all of their debt. I don't expect them to do that, but they could. The other thing I would point out is their interest coverage ratio is 51, meaning that with earnings alone going forward, they can well cover any debt that they have on the balance sheet. Now, one other thing I'll point out is, and this comes from their materials, but if I was them, I would definitely be showing this as well. Their free cash flow as a percentage of revenue is in the 89th percentile, meaning that there's only 11% of the companies in the S&P 500 that have a better free cash flow as percent of revenue. And on return on invested capital, they are in the 97th percentile, which means only 3% of the companies in the S&P 500 have a better return on invested capital than Texas Instruments. So the financial numbers for Texas Instruments look really good. Let's now take a look at their allocation of capital. It's important to point out here that they see really 4 areas to allocate their capital. The first is R&D, sales, marketing, CapEx, and inventory. That's what they call their organic growth of their business. So they're looking to grow their technology, the skills of their people, the ability for people to buy from them. They will increase their investment in capacity, so buildings, machinery, equipment, and then also inventory. And you can see that from 2012 to 2021, they have invested a little over $30 billion, let's just say $33 billion in organic growth type areas. So the second area is in share repurchases. Looks like they've invested about somewhere around $25 billion over the 2012 to 2021 time period in share repurchases, which is pretty significant for a dividend growth investor. And then also they have paid somewhere in the $20 billion range in dividends over that same 10-year period. It's important to point out too that they have some pretty high capital needs, especially for capacity. You can see that they have built, and they're in the process of building a plant in Richardson, Texas. It's a 300 millimeter wafer fabrication building. They're looking for output of that to start in the second half of 22. They bought a facility in Lehi, Utah. It'll be the fourth 300 millimeter wafer fabrication facility. It's expected to start output in early 2023. And then they've announced a fifth to eighth 300 millimeter wafer fabrication plants in Sherman, Texas. And that construction will begin here in 2022 and expect production in 2025. So in terms of capital allocation, this is what we want. We want them investing in their business. We want them buying back shares when it makes sense to do so. And we want them paying dividends out consistently and then consistently growing those dividends to shareholders. And if it makes sense, to enter into some acquisitions. So this is a great capital allocation model, and they seem to be performing it very well. So now let's turn to valuation. What is this company worth? According to Morningstar, this company is worth $166. But I also took a look at CFRA's valuation. Their valuation came in about $110. So it caused me to pause and try to figure out what was going on there. And in reading the write-up from CFRA, there's some inconsistencies there, and so I'm not really sure what's happening with CFRA's analysis. So therefore, I decided to do my own discounted cash flow analysis, and and I came out actually with a valuation of $203. And guys, I included only a 4% growth perpetually in their free cash flow moving forward. And if you recall, the last 17 years they've had 12%. I think this is pretty conservative, and my required rate of return is 8%. So at a $203 valuation, I got to think that maybe there's some things I'm not aware of, and so this may not be as conservative as it should be. That's why I like using something like Morningstar, who has a good write-up on the valuation. So I am comfortable with Morningstar's valuation of Texas Instruments. So I believe that it's valued somewhere around $166. You can make your own decision about what you think the value is, but I am very comfortable with this value. So with that being said, let's move into looking at the 5 points of assessment that I like to do before entering into a stock transaction. So we saw that the financial assessment, with their great payout ratio, their phenomenal return on investment capital, the zero net debt, and their interest coverage ratio, financial assessment, they're just knocking it out of the park. In terms of capital allocation, they have a tremendous capital allocation model. They've repurchased over 200 million shares in the last 10 years. They have greater than 40% free cash flow going to organic growth. More than 30% is going to share repurchases and about 25% to dividends. And their valuation, according to the Morningstar valuation, is at about a 7% discount. The other two areas have to do with the company's strategy and the company's management. So let me just talk about a couple of points on the strategy. Morningstar gives them a wide moat rating. So there's some huge barriers of entry to this industry. One is that analog technology needs expertise, and that is in short supply today. And also they need capital. Any competitor would need capital for entry into this market. A great part of their strategy is that they have 62% in industrial and automotive. Both of those have longer lives and higher switching costs than some things like computer equipment and personal electronics. Those things, the computer equipment, personal electronics, those tend to turn over really quickly. But industrial applications and automotive applications, those don't tend to turn over as quickly, and therefore there's more opportunity for them to make money. So then the last area is in company management, and with a long-term growth rate of free cash flow at 12% per year over a 17-year period, they're investing significantly in organic growth. They also have a dividend growth streak of 18 years while having paid dividends for 33 years. And they have a 5-year CAGR of 21%. What's not to like about Texas Instruments? So there's no doubt that Texas Instruments has great financials, capital allocation, valuation, strategy, and management execution. I mean, they hit the ball out of the park in all of those categories. What does the future look like? Well, it looks like it might be a little bit flat in terms of forecasting, but with all that's going on with inflation, with supply chain shortages, I am not shocked to see their forecast be kind of flat. And as a matter of fact, it gives me some comfort because all of that flat growth in the next 2 to 3 years is priced into the stock apparently. So could it go down further? Absolutely. Will it? I have no idea. That's part of the art of investing. And so the approach I'm going to take is I'm going to wait for some of the earnings releases to come out in the second quarter to see where things head. My guess is the market is going to drop a bit as companies begin to report some earnings that are going to have these high inflation numbers in them. And at that point, I am likely to pick up more shares of Texas Instruments. So let's take a quick look at the portfolio update through June the 24th. You'll notice that the portfolio went up $40,503 in that week. We got $529 in dividends, all from the growth account. And so therefore the market change was $39,974. So we went up, the portfolio went up 5% in the week. The S&P 500 went up 6.4%. So we trailed the S&P 500 by about 1.4% for the week. But when we look at it on a year-to-date basis, we are now only down $35,000, which is 4.4%, while the S&P 500 was down 18.4%, which means that we're outperforming the S&P 500 by 14%, double digits. And I'm super stoked about that. So if you've hung with me this long, I appreciate your time and attention. If you would, in the comments below, let me know what you think about Texas Instruments. Are you a buyer here? Are you on hold here? Do you have them at all? Are you looking to buy them? I just want to hear your feedback and your comments on Texas Instruments. So leave me a comment below, and I would really appreciate that. And again, if you like this kind of content, consider subscribing to the channel. Give the video a thumbs up. It lets people know that the content is decent. And with that, I'll see you on the next video.